Hello, this is Matt Russell from Daily FX Education, and today I will be discussing support and resistance. The first thing I wanted to discuss today is the proper drawing of support and resistance lines. And one of the biggest mistakes I see newer traders make is they might open up their charts, let's say, on a Sunday night or a Monday morning, and they've already decided which direction they're going to go on a currency pair, and they're going to fit their support or resistance lines to suit that trade idea. And here's a good example here. I'm imagining that the market is right here, and again, this is a Sunday night or a Monday morning, and the trader wants to go short. Let's say it's the euro dollar. Maybe they read some kind of fundamental article over the weekend or something like that. So they're going to take their line and draw it like this, connecting these 2 points, sort of just ignoring this line here because they have 2 points for a resistance line, and they're going to look to enter the trade right there. And what I would say as an instructor on the course is I'd say, no, that's not the proper entry. That's not a valid resistance line, even though you have 2 points. We're going to draw the line using the wick highs. And I'm sorry, but you're just going to have to wait for prices to come up and hit that resistance line, because that is the proper entry, and it's the most objective way to apply simple support and resistance lines to your analysis. Another method I often see is a trader will use the body in drawing the lines, and that will actually give them a closer point in this example to enter the trade as well. And that's the biggest thing, if I can impart to you, that you want to avoid is subjective analysis, trying to fit your trade idea using support and resistance lines, fitting it into your analysis. You have to avoid that, and the best way to do it, in my opinion, again, is to only use the wick highs and wick lows when drawing support and resistance lines, because it gives you sort of a free rein in terms of it frees you up because you're not too concerned about getting the proper entry, and it's all a matter of managing your emotions. Because a trader who's drawing the lines like this, who's sort of cheating a little bit, is scared that he's going to miss this trade. And that's an emotion that you have to get over. And the way to get over that is to draw your support and resistance lines effectively. And also the best thing that can happen to you a few times as a newer trader is for prices to get within just a few pips of where you want to enter and then reverse to the downside. Because that's the fear. The fear of that happening is what's causing you to draw your support or resistance lines incorrectly. And that's an emotion that you have to get over in order to trade successfully. The second thing I wanted to discuss is channel lines, and it's sort of like a secret method, if you will. I like to feel like I'm cheating a little bit when I'm using it. So the most simple way to apply channel lines to your trading, let's say this is the price action right here. I'm just looking at the chart, and I can see 2 highs. I'm just going to draw a simple resistance line, again, connecting the high points for the resistance line, and using candlesticks, I would be using the wick highs. And the easiest way to create a duplicate line, which is what you will have to do for a channel line, is to just connect these 2 lines, move the line, and then draw another line. Most charting packages will give you the option in terms of creating a duplicate line or a parallel line, but this method you could do on any charting package. It might not have that capacity. Again, just connect the highs, move the line, draw the same line. That will give you 2 lines with the exact same slope. And then what you would do is you would move the first line back to the original position and take the second line with the same exact slope and connect it to the lows over here. And that will give you this point over here, which will sort of be the hot spot where you want to enter the trade. And again, I kind of feel like I'm trading, because if you're just looking at this chart, you're looking at a potential support line here. There's no reason why the market should bounce, except you have this little bit of information up here. Again, the market sort of revealed a little piece of information. You're going to use it to your advantage. And I like to call this like a 3-prong approach. This is the first point, this is the second point, this is the third point, and we're going to look to enter at that 4th point, and that creates the proper way, that creates a proper channel. And again, we're just going to treat it as a simple support or resistance line looking for entry. In this case, again, it's going to be a support line. We're going to look to enter just above the support line with a stop maybe 30 to 50 pips beneath the support line. And also, like I mentioned in my previous videos, what I like to look for personally is at least short-term confirmation that the line is acting as support. And again, that might be as simple as, let's say this line is at 140, price is coming down to 140, then bouncing up to 140.10, and then coming back down to 140. That's where I would look to enter the trade. Again, my name is Matt Russell from the Daily FX Education team. Thank you for listening.